Imagine your daily commute. On one side of the barrier, drivers are trapped in bumper-to-bumper traffic on a crumbling city street. On the other, cars zoom past effortlessly on a wide-open, perfectly paved private highway. This divide traces back to the early 2000s, when local governments hit a financial wall. They faced massive pension liabilities and degrading infrastructure, but served an electorate that aggressively rejected any new tax increases. The public sector was effectively out of cash. Public-private partnerships, or P3s, offered a way out. Global infrastructure funds, backed by pension capital and Wall Street, offered to hand cities billions of dollars in immediate cash. In exchange, the private firm took over maintenance and repaving for the next 99 years, keeping every toll dollar collected in the process. For politicians, these deals looked like a windfall. In 2004, Chicago leased the 7.8-mile Chicago Skyway for 99 years, receiving $1.83 billion in cash that allowed the city to balance its budget without raising taxes by a single cent. Critics saw a different reality, a fire sale of public geography. By signing these leases, governments handed over absolute monopolies. Once the ink dried, every commuter wanting to save 40 minutes of their life was forced to pay a private corporation for the privilege. To see who actually wins in these deals, we have to look at this economic matrix. By tracking how three specific financial mechanics distribute risk and reward, the true cost of the private highway becomes clear. The first mechanism is debt leverage. Private equity firms rarely buy a road with their own cash. They use massive amounts of Wall Street debt to fund those multi-billion-dollar payments to the cities. The private firm takes on the financial burden of that debt, shielding the public treasury if the project fails. This chart shows why that risk assessment is often skewed by systemic optimism bias. To justify borrowing billions, firms use traffic and revenue studies. The blue line represents what consultants project: endless growth. The red line is the reality. Traffic often plateaus as local economies shift or gas prices rise. The 2006 Indiana toll road lease proves the danger of these models. Operators borrowed over $3 billion, assuming freight traffic would skyrocket. When the 2008 recession hit, truckers diverted to free alternative routes. Revenue crashed, leaving the company unable to pay interest, triggering a 2014 bankruptcy. When these highly leveraged deals fail, the private equity is wiped out, but the public is left managing a bankrupt regional transport artery that still carries thousands of people every day. The second mechanism is dynamic pricing. Algorithms monitor traffic density in real time and hike the toll rate as congestion increases. This manages demand, ensuring the toll road stays at high speed even during rush hour. This creates a perverse incentive. On a private road, public gridlock is the primary revenue driver. The more local streets fail, the more a private operator can charge for their escape hatch. Toronto's Highway 407 ETR is the ultimate case study in unchecked reward. Under the terms of its 99-year lease, the operators were granted almost unlimited freedom to raise rates as long as they met baseline traffic targets. This chart shows the scale of that windfall. In 1999, the road was leased for $3.1 billion Canadian dollars. Today, after toll rates were pushed up nearly 600%, the highway is valued at well over $30 billion. Dynamic pricing extracts a premium from commuters who have no choice but to pay. It converts public frustration into a private dividend, monetizing time rather than solving congestion. The third mechanism is the non-compete clause. These are standard investment protections. If a private fund invests billions to maintain a highway, they need a legal guarantee that the city won't build a free parallel highway immediately after the check clears. In practice, these clauses can block cities from fixing their own streets. If a local government wants to add a bike lane, build a light rail line, or widen a gridlocked public road, the private operator can sue for stealing their traffic. During the 1990s, California wanted to widen State Route 91 to fix a dangerous safety bottleneck. The private operator of the adjacent toll lanes used their non-compete agreement to block the construction for years. The state eventually paid $207 million to buy back the lanes just to regain the right to improve its own transport network. Non-competes represent a massive risk shift. They trap taxpayers inside legal boundaries that penalize civic progress to protect corporate revenue. Public backlash against 99-year monopolies and non-compete clauses has largely ended the era of the massive asset sale. The modern model is managed Lexus lanes. States partner with private firms to build high-speed express lanes inside the median of existing free highways. As this electronic express lane sign shows, the road is divided by wealth. Those who can afford the surge price get speed, and everyone else pays with their time. This digital roadmap shows the next evolution: GPS-based vehicle miles travel tracking. As gas tax revenue disappears, governments are exploring ways to turn every mile of every public road into an automated, micro-tolled surface. With public infrastructure funds exhausted and maintenance costs rising, many cities view private capital as a structural necessity. To them, the ability to build and maintain massive projects now outweighs the long-term cost of private control. When we outsource our geography, we must read the fine print. Every automated beep of a toll transponder signals a dividend paid to a private investor. That cost represents a permanent tax on the right to move through our own community.